I'm Charlotte McLeod with Resource Investing News, and here today with me is Mercenary Geologist Mickey Fulp. Thank you for joining me.
Thanks for having me once again, Charlotte.
Yes. So I wanted to start off by saying you've been on camera lately with Cipher Research talking about some of the problems with major gold miners. Specifically, you've touched on issues with how they report costs. What I'm wondering is to what extent is that an issue with reporting regulations and not miners themselves?
Well, it's a combination of reporting regulations that allow accountants to essentially cook the books, but the miners have been very guilty of exploiting those loopholes in the rule, and basically what they're doing is they're capitalizing expenses to make themselves look profitable in the short term, but it comes back to haunt them with these write-downs we see when the gold price goes lower.
Right. Now, I would imagine that's not an issue only in the gold space. What about other?
Oh, not at all. It's very much an issue in the entire mining sector. It's probably exacerbated right now in gold space because of the drop of gold from 1,900 to a little less than, well, today probably about $1,115 gold. But it goes on throughout capital-intensive industries. For instance, oil and gas industry has the same problems. And I dare say probably other capital-intensive industries, perhaps such as railroad and construction companies, likely have some of the same problems.
Wow, okay. So now looking back at gold companies specifically, one of the issues you've mentioned with those big miners is profitability. And we saw that recently with Allied Nevada. Should investors be expecting more bankruptcies like that?
I think there's more bankruptcies coming. What's happened is as these senior debt notes have come due, then that's when the piper has to be paid, and that's when you're going to see companies start to default on debt. And generally their collateral for their debt are their assays. So yes, I think we're going to see more bankruptcies in the future.
Right, and looking at debt, you've mentioned that is something that miners often take on when they're making acquisitions. And people tend to get excited about mergers and acquisitions. So should we really be getting excited?
Well, what's happened is, to use a phrase, during the 11-year bull market for gold, 2000, which we covered in my musing and the videos in 2003 to 2013, with a gold price that went exponential, then went parabolic, and then went off the other side. The miners essentially spent like drunken sailors. So they paid too much for acquisitions, and they've taken the tactic that rather than find their own deposits, they've acquired deposits because the juniors generally are the better explorers. They paid too much for the acquisitions, and that's not good in the long term.
No. Okay, now switching tactics, what can you tell me about the zombie miners on the TSX Venture? Well,
there's been a lot of talk, a lot of buzz on the street for quite some time, actually, among some newsletter writers. I'm not the only one that's been on this bandwagon for a couple of years about companies that are not solvent that are still on the Venture Exchange. A guy named Tony Simon, who's a CPA and a former auditor in town and very much involved in the junior sector, did a massive study and figured out that 600 of the 1,200 exploration and mining companies, I mean, that's basically 50%, have negative working capital. And for some reason, the exchange is not following their own regulations and delisting these companies. There's a group of us that think before the industry can get healthy again, we need to eliminate the zombie miners.
Okay, right. And now how does that play into PDAC?
Well, unfortunately, I didn't make it to PDAC because of freezing rain in Dallas and a snowstorm in Albuquerque precluded a couple of days of me flying to Toronto. But in the meantime, what I did do is I took all the exhibitors at PDAC and I compared them with the 600 zombie miners, and I found out that 52 of those companies were paying for exhibitor booths at PDAC. So tell you the truth, I think that's a little bit unholy. How are these companies that have no cash and have, in some instances, millions of dollars in negative working capital, which means they have not been paying their short-term bills for a very long time, how do they afford to have an exhibitor booth at PDAC? Because those booths aren't cheap.
No, it's a good question. to end maybe on a little more positive note.
Let's do that.
What are some companies that you do like?
Well, there's a couple of companies that I like right now. I very much like Uranium Energy Corp. It's a contrarian play. It's the most highly leveraged domestic producer in the United States to a higher spot uranium price. So we've seen uranium go from $28 a pound to $39 and change now. And once it hits the mid 40s, UEC will go into ramp up to full production again, and so I like that for contrarian uranium play. That company I own, and it's a sponsor of my website. The other one you might take a look at would be Nevada Sunrise, and it's a company I own but have no other relationship with. They have 21% of Pilot Gold's Kinsley Mountain discovery in Nevada, which has potential to become the next big gold play in Northeast Nevada. And I very much like that. So versus owning Pilot Gold, and it's got 15 projects, including a couple of other ones in Turkey. I like the idea of owning 21% of Kinsley Mountain through Nevada Sunrise, and that stock is pretty cheap right now, about 32 cents with a market cap of about $7 million.
Okay, well, thank you for the insight, and thanks for joining me today.
Well, thank you once again, Charlotte. Always my pleasure.
Okay, and this is Mickey Fulp, and I'm Charlotte McLeod with Resource Investing News.